Hello, everyone. This is JJ Richa, and I have with me today Jeff Koenig. Jeff belongs to multiple angel groups, including Techos Angels. I am going to let him introduce himself in a second. Before that, I would like to just tell you a little bit about our program today, and I will start by talking about what we've been doing. So we have been running this live chat really since about February this year. And the purpose of the live chat is really to help entrepreneurs learn more about what it takes to really start a business, build a business, and potentially get to a point where they're selling that business. And one of the most important things that as investors we look for is really the financial projections and the financial well-being of a company. So that's what Jeff is going to be talking about today. First, I would like to tell you a little bit about. So, if you have not subscribed with us on YouTube, please do so today. Also, if you have not followed us on social media, please do so as well. The program will be about an hour. And then we will have an open discussion about basically street financing, like Jeff called it. So we will talk about that. And so if you have any questions, please do not hesitate to really ask your questions today. The way you do it is through your chat box. So all you have to do is just type in the questions in the chat box, and I will moderate the questions as we're going through the program. Also, I want to talk a little bit just briefly about the startup business plan competition that we've been running. It's been going on right now for about a little over a month with open applications. Applications will be open for another 3 weeks. So if you want to pitch to investors, present your business plan, please sign up today. I will put the URL in the chat in a little bit, just in case you haven't heard about the competition. We have 120 investors that will be judging the competition, and also we have 42 angel groups and VCs that will be part of this competition, potentially allowing some of the participants, applicants, and the winners, of course, to fast track directly to their screening. Before we start, I'm going to do a very quick information about Pismo Ventures and what we do. So what we are a venture firm and a venture studio with a software development arm. What does that mean? If you have custom software, we're potentially willing to be able to help you with that as well. Also, so what we do is we help build businesses. We invest in businesses, both resources and cash, meaning human capital, services, and also cash. We also develop software. Like I said, we facilitate funding as part of what we do, because if we have skin in the game, we want to make sure you succeed. We open doors as much as we can to help you succeed as well. We are building a fund. It may not happen this year because of the climate that everyone's been into, but we will. We are a value-based hybrid cash and equity friendly model. We engage with our companies on a month-to-month basis, and we are a true business partner and investors with our portfolio companies. Jeff, thank you. Good morning.
Good morning.
Well, tell us a little bit about yourself so the audience knows a little bit where you come from and all the different angel groups you belong to, which is awesome.
Well, I've been a career micro business guy. I've been in and out of a dozen different, and somewhere along the way, quite a while ago, I started consulting. I do a lot of fractional CFO work, but really with a focus on strategic planning for businesses to achieve and maintain profitability. Started angel investing some years ago. I have been part of Mid-America Angels in Kansas City, Plains Angels in Des Moines, I've done some investing with Rocky Ventures. I'm on the board of the Desert Angels and also a member of TCA in Orange County. And I do a little bit of federal advocacy work in DC for small business.
Well, Jeff, thank you very much. The subject today is really all about, I'm sure many of the listeners would like to know what you really think about financing, especially for startups. One of the biggest questions I get, I hear is that I have an accountant. So why do I need a CFO function? What's the difference?
Yeah, but you know what? I get that question too. I think a lot of people have that question, and really accounting and finance get lumped together, but because they're dealing with the same financial information, but they're really two different disciplines. And so I'm speaking to you here from a street perspective, you know, not the lofty definitions in business school of what these professions do. So on Main Street, accounting is generally preoccupied with ratting you out to others you have obligations to, right? Like Uncle Sam or your bankers or your investors. And I say that tongue in cheek. They're not trying to hurt you, of course. They're trying to protect you from getting into trouble with somebody. It's a defensive thing. Accountability, right? And so accounting is like going to confession. But finance is something that you should look forward to, not just put up with and accept. Finance is playing on offense. Uses financial information that helps you make strategic decisions about a future that you're trying to create that hasn't happened yet. And so finance is about planning, whereas accounting is about recording and reporting. Finance doesn't total the battle casualties. It's planning for the next battle and putting resources in place to make sure you win. So if you see the difference, then every business that wants to succeed really needs somebody doing this detailed financial planning, right?
That's very interesting, Jeff. You know, you said it in a different way, but someone told me one day, and it is true, is I guess accounting is about the past and finance is about the future, really.
Mm-hmm.
That's about right, because you're looking at what happened, and finance is you're looking at what's going to happen, what do you need, cash flow, etc. Mm-hmm. Very interesting. When people, one of the things that people always ask is you know, they're trying to grow, and they're trying to fill in potentially technical, executive positions that they need to help their startup succeed. So, how can looking in the future when it comes to financing help with building the need of what they're looking for as far as filling the human capital that they're looking to fill?
Well, you know what I think you were referring to, firefighting has filtered into our business language, right? Because as founders, we constantly feel like we're just fighting fires all day long.
Yep.
And what's the next threatening thing that's getting out of control? So when you're ready to leave your garage with your innovation and hit the street, you quickly realize you need legal docs or advice. And so you identify your CLO, which ends up being your outsourced attorney at first, right? Yeah. When you can't be your only salesperson anymore, you look for somebody with the CSO skills to build out the sales team. When you got to start hiring straight pay employees, you need the CHRO skill set. A lot of founders eventually end up having to accept that they prefer being on the test bench. They like COO work. They don't want to be the head PR and fundraising guy, right, or gal. So they need to find a CEO. And the accountant was identified early on. You already had your CAO. So the first skill set you really needed that you forgot about all along, as soon as the first light under your garage door appeared, was the finance skill set. Dollars to a business is what an EKG is to a heart doc. And every other departmental function in your business needs performance goals and a budget. So you need to know how much when you can reliably expect first revenue, how much that's going to be, how much labor and marketing you need to invest ahead to get that revenue. And if you haven't got a strategic plan that lays all that out, then all these other functions are rudderless and they tend to become financially wasteful, even if that's all concentrated in just one or two people.
Very interesting perspective and the way you put it together. That's really, at the end of the day, it's about cash is king. And unless you know what your future needs for cash, well, also you kind of need to know if it's a complete startup, you don't have any track record, you don't have the past. But if you have some past information, then you can use that to predict future financial needs. So what is okay? So talking about CFO potentially, but how about someone says, you know what? Can't I do my own accounting stuff? And why do I need a CFO? Can I use a controller maybe? So what's the difference there? Maybe people don't understand the difference between a controller and a CFO, and maybe they could do stuff on their own.
JJ, no matter what I say, most folks listening are going to try to DIY finance as long as they can. And that's almost guaranteed if you are a first-time founder in a significant startup. You don't think you need help because you understand how money is made already, right? Buy low, sell high, simple. You can also go outside and mow and trim your lawn and predict which blades of grass are going to grow taller by next week because you understand how grass grows, right?
Yep.
So we improve only what we measure, okay?
Yep.
And novices at corporate finance planning fall into taking their measurements last because they're driven by the accountant. It's mostly measurement and analysis that isn't fun to them, and they'd rather be doing other things as founders in their business. So another great reason that someone other than the COO should be the CFO is it needs to be somebody's first job every day to measure activity and translate that into the business's lifeblood, which is cash, like you said. Cash is king. They got to know what's coming in, what's going out, what today's balance is, and what we expect tomorrow's cash balance to be.
Yep. Okay. And someone who's never done that before, like you said, they're not going to really know how to do it. A CFO, that's what they do. And so it is important that someone really uses a professional for that purpose. Unless they are the CFO, then that's fine. So again, other questions that I get asked: why do I need to be concerned with charting a path to profitability and exit before even booking my first sale? I mean, that's a really big question. And people ask it all the time, saying, why do I need to even try to predict 3 years of financial projections before I even make a sale?
Most authors who write a story already know the ending before they start writing the first chapter, okay? It's kind of already in their head, all right? I argue with accountants all the time, mostly accountants that just serve a small local client base, that the most important reason for their clients to keep well-organized books is not to pay taxes or give others reports. Okay? It's to produce informative information for management in order to interpret the results of their past decisions and make the next ones to improve their performance. The tax and the information returns are secondary. And you may or may not be surprised at how many local tax accountants think the method of accounting, like the cash versus accrual thing, or how they organize the chart of accounts should be optimized for tax preparation instead of for owner interpretation for their own business success, right? So in my mind, finance has, we have our own missed priority too, that finance professionals need to drill past and get beneath. The most important purpose for financial planning isn't just predicting the future, although we're certainly going to do that. The underlying greater purpose of finance is to quantify our assumptions, discover where they don't reconcile or add up, and then uncover those risks that can sink our ship. Okay, so we got to make plans to mitigate those risks. And risk analysis, it needs to be qualified in dollars and cents. Here's the simple reason for that. Math isn't emotional. And calculators don't generally under or overestimate because of bias anchored to our hopes and dreams. Okay, if the whole company plan, from start to end can't be proven in the numbers first, then all the decisions that we make on hope and faith are like trying to swim to shore in the middle of a lake on a pitch dark night. You can end up, swimming in circles and have no idea where you are until you're exhausted and sink.
Yep. This is like having a rocking horse that moves but doesn't get anywhere. That's very interesting because I think we hear it all the time. There, unless you actually measure, have metrics that measures really what you're doing, you're not going to be able to really move that needle forward. So, again, some of the things I hear from entrepreneurs is that, you know what, I'm profitable. As long as I'm able to continuously show that I'm profitable and that I'm growing sales, there is no way I can go bankrupt. Is that true?
In the asking of the question, it kind of hints that it is a trick question, right? But many are the scandals, of bankruptcies in the midst of a positive internal operating profit and growing sales, and yet these companies ran out of cash and couldn't recover. A classic example is slow receivables, right? You can book a lot of sales and complete the work, you've delivered it, and so you've properly posted income, and it looks great on the profit and loss statement. You
never got the cash.
Never got the cash, right? So that happens to like building subcontractors all the time, right? That's like the major problem in their industry is getting paid, and it's just one of the many ways that a company can be asset rich and yet get killed. So, you said the phrase cash is king. Profitability has a certain element of the phantom and the immaterial to it, mostly because of our stupidly complicated taxation system. Okay. Yeah. But the statement of cash flows is the most important statement that we never look at.
Nobody looks at.
Nobody looks at the statement of cash flows because it's more fun to look at the profit and loss statement and we understand it better. Right. Yeah. But in our combined experience, yours, mine, many angels, many past founders, it's the last one that gets looked at.
Yeah. So the answer to the question, you can really go bankrupt real fast. It doesn't matter how much profit you have on paper.
That's right.
So, I mean, it could be many things too. It could be, other than the example you gave, it could be potentially companies that are growing so fast and their operational infrastructure cannot handle the fast growth. That could put them through bankruptcy as well, right?
Oh yeah. Because, you're committing to things. These are obligations. If you're leasing new corporate space because you got to get new employees hired and get their computers in. I mean, a lot of companies that really get going end up with a bigger challenge than they had before de-risking their business if they haven't planned the cash flow they need to get through those growth phases.
Yeah, years back, maybe 7-8 years ago, there was a company out of here, Southern California. They made a deal with one of the big box stores. I won't mention it. And because they made a deal, they were a manufacturing operation. They actually leased a 60,000 square foot warehouse to get ready for all these new orders that will be coming. Orders never came. Company went out of business very quickly because of all the debt they had. They borrowed an additional $3 or $4 million to really set for that growth. So that's another thing. Sales
Sure.
are coming. Don't overcommit before the sales come.
Oh, I will name a company because it's, everybody already knows Walmart's famous for doing this to small manufacturers.
Yes, I was gonna. Yeah. Okay. There you go.
I mean, that story's been out there for decades, right? And
Yeah.
it isn't, anything malicious. It's just when you have a really, really, really big buyer and a small supplier, okay, that buyer has already got so many systems for planning, finance, and logistics and operations, but that little manufacturer doesn't,
Yep.
and they need to. They need to before selling to a player like that.
That requires a lot of planning, and any help to get that from a CFO or anyone that has experience with them, that's really what they need.
Mm-hmm.
Sales projections are hardly worth, the paper they're being printed on, really. And is there a way to nail them properly? I mean, because it's really hard to say, I'm going to sell 3,000 widgets. So I think you spoke about assumptions earlier. And I think, from when I'm looking at this, I try to validate the assumptions. What are your thoughts on what makes those assumptions right, or the projections right?
Well, so those of us that have been in the investor room after a company pitches and has left the room, what are the things that we sort of smile at the most, or sometimes even laugh? It's the projections and then the valuation that those projections drive, right? And I think I mentioned firefighting. Wouldn't it be great if a fire department could pre-plan which structures would catch on fire every year, and then move all its resources, plan its budgets, have the right equipment and staff to perfectly meet the need? I mean, nobody'd ever get hurt, and we'd never need fire insurance anymore because they'd always be there to put it out. But here's the good news: businesses are not subject to the same laws of utter unpredictability and randomness as structure and forest fires. But we probably focus more mathematical effort on calculating how fires grow than we do on how businesses grow. So not only can we nail sales projections, and I've done it many times, not doing so makes most companies liars by omission. Now, what they've omitted is the effort to learn how to do them. Look, we're in a political season right now, right? And politicians make statements of belief all the time. Things they think that are true, things they think they can make to be true. Are we all just going to give them a pass when they miss the mark? Because we all understand, well, those are just political statements and nobody expects them to be a reality. Now maybe we do. And if so, shame on us as a people. Yeah. We give them power, we pay them to keep promises, and if they don't, they deserve to be thrown out and replaced. Well, it should be no different with companies. Investors make big bets on that management of that company has the right plan, and that they have themselves already plumbed all the depths of their own plan and figured out where all the holes are and plugged them. And if we don't expect that as investors and just say, spend some money, and when you run out, come back. In my consulting and educational activities, I teach entrepreneurs how to get this right. And in fact, the process of breaking down their customers' purchasing decisions into the lowest common denominators, analyzing them, and then building them back up is what uncovers huge unaddressed risks. So you got to do your homework, and you can build a moat for yourself as a founder around your business and maintain the bridge over it if you're just willing to do that work, or get somebody that's willing to do that work up front and not think of finance as the last function on your team.
You emphasize this so well that, I don't know if it needs more emphasis. So it's that important. You can get it right. There's no way around it. You better get it right, because otherwise, why would investors invest? We have a question from Kirk, so I want to remind everybody to please go ahead and post your questions here for Jeff as soon as possible. So here we go. This is from Kirk, and says, When you are planning your strategic financial analysis, how much should be put into hard triggers for change, scaling? If a founder states, when we make X in revenue, we will take on a full-time employee.
Thanks for the question, Kirk. And I think what he's really speaking to is something I call set it and forget it. In other words, are you supposed to make a financial plan for the future that, you've done all this work, you've got this plan, now that's it, that's what we're going with, we're sticking to it, it can't change, if we get new information, tough. Well, of course not. It's kind of like if you've ever watched a sound mixer in a concert, right? They don't do sound check and get all the knobs and dials and buttons in some fixed spot and then just sit back and enjoy the show. Okay, they are playing that mixer like you play a musical instrument. And the financial plan is constantly being revised. As new information comes in, you adjust.
Yeah. So I guess one of those things is that Kirk is talking about is again, when we make X in revenue, we will take an additional employee, but there's a lot more to it than just that, right, Jeff?
Mm-hmm. Yeah, absolutely.
Right.
I mean, yeah.
Okay. So since some of them they can't nail the projections, so we talk about that, and they should nail it. Why do I need to bother with long-term fundraising plans? Because that's why they're doing the projections, because they're thinking that if they can't nail it, why should they have it? But you should nail it. So what's your answer to that?
Yeah, I mean, if you don't expect to be able to produce quality projections, then it may follow that you might as well not bother with a long-term fundraising plan, which is better called a capitalization plan. Without good projections, your plan is just hyping your belief that you're going to somehow figure out a way to succeed and sell that idea brilliantly, and then keep asking for money from whoever's willing to give it to you. And you're just counting on luck. And sadly, that's not the exception. That's kind of the rule in the angel capital experience. Most of the time, we're hearing from people who are just saying, look, just trust me. Just believe in me. I know I can get it there, right? If you have a launch to exit comprehensive financial plan, though, and if your own team blew holes in it and reconstructed it over and over until you couldn't find an unidentified risk left, then when you go out to raise capital, you know exactly how much money you need and when, right? And you can show that to investors. You can let them see your assumptions and it'll make a lot of sense to them. And you'll be in rare space because you'll be perfectly poised to actually exceed your projections when so many other companies have had rose-colored glasses on when they built the projections that they did.
So, I agree with everything you said, but sometimes somebody may be right. They may be 100% sure that their projections are right and they think they nailed it, but then they miss the mark and they miss the mark again. Is there an excuse that they can give to investors? Like you said, if your assumptions are right and investors believe the assumptions, how could they explain that they missed the mark?
Usually, if they really did have rigorous projection building, in other words, they didn't just look at 3 variables, like X number of customers at Y price equals Z sales. They went a lot deeper than that, and they miss, then usually that's a function of execution, right? Okay. Now, a great plan is supposed to guide the execution plans, that's okay? Right. But we're human and we take risks on people we hire, and things go wrong on the execution side. The execution would normally be what they have to talk about as to why they missed.
Yeah. All right. We have a question from Mary. Mary says, hi, Jeff. In context of COVID, given the principles you've outlined, do you recommend that plans for a startup be put on hold, a specific approach that makes sense from your perspective?
Okay, I'm going to give a really unsatisfying answer, Marie, and it's a definite maybe. So, it really, really, really depends on the industry that the startup is in. Here's a really simple example. If you've got a great idea for a new restaurant concept in your local market, okay, well, obviously there's a lot of, red ink in the restaurant business right now, and it hasn't shaken out yet. There's still a lot of closures to come, sad to say, but it hasn't all happened yet. And
Yep.
You don't really know what your competitive landscape is. You don't know who's going to survive that you're competing with, and who's going to leave empty space that if you rush to market, there might be a way better location that you could have grabbed.
Yeah.
So that'd be an example of waiting. Now, are there other industries that are actually being advantaged by COVID, like say the building trades, because everybody's doing home improvement projects right now? Well, heck yeah. If you've got some great new invention for the backyard patio or something, I'd get that thing to market. So the answer is maybe.
It's a maybe. We have a question from Gary. Gary says, as entrepreneurs are creating and sharing projections, how do you best convey honesty and balance between optimism and pessimism without losing the confidence of investors?
Great question, Gary. And this goes back to why you want your finance management function to be somewhat separated from your CEO and COO functions, because it's the role of the CEO to sell the company and the COO to build great stuff, right? And they're always going to be optimistic. So you need somebody that's a check and balance against that. And it goes back to the numbers don't lie thing. Tell me all your plans, let's quantify that and let's test that. And if the numbers show us that it's not adding up, then it forces us to deal with why it's not adding up.
And stop selling and start building the right stuff. And here's another question as a follow-on to Gary's question. And it says, continuing on Gary's thought, is there any benefit to projecting super low during fundraising to show our connection to reality and avoid this silly appearance of dreamy founders?
I have seen some companies that did a really good job of using super conservative projections. Here's the challenge. Margins are tight. That's the nature of a competitive landscape, right? So unless you're you're so fortunate to be in some kind of really brand new industry and you patented the whole thing for 20 years and nobody can compete with you so that you can have big fat margins, right? You're going to need to be able to show that you can operate, that your expense structure stays within your revenue. So yeah, go low on revenue projections, but make sure that your business operational scale matches that, or else what an investor is going to see is you're expecting to sell $1 worth and you're going to spend $100 getting it. There's no opportunity in
that. Okay, that's really interesting. And another way of saying it, you can always take your profit margin to the bank. You can't take anything else to the bank, right?
Ultimately, yes. You can go without profit for a while, but you got to show when it's going to happen.
Yeah. So I'm going to follow on that as well, because, you and I, and we've been doing this for a long time, we always see, well, if we only get 1% of the market with our super low projections, we're going to make billions. Do you like that, or are you looking for more substantive?
Well, I do think that TAM, SAM, and SOM, those acronyms for measuring the value in the marketplace are very important, and every company should do that analysis. The biggest mistake that I see is that they tend to overestimate the larger numbers because they're counting dollars that are cycled through the system twice, 3, and 4 times, or they're counting, or they're really including purchases that are not exactly a like kind purchase to the kind that they're asking the customer to make. So it's really good when you're doing market research. If that's not your field of experience, you should probably get some outside help. There's some great companies that do that, but you should have multiple sources for every market research assumption you make, not just one, or not just the one that looks the best. It's just like the way that an appraiser appraises a building. You don't do just the cost to rebuild it. You also go look at comparable sales. You also look at what's its income stream if it's a rental property, and you mix these together. And your market research assumptions should use multiple sources and be conservative.
All right, we have another question here from Arizona Roadways. How much of the fundraising process should be part-time CFOs handled by a part-time CFO? As angels, we typically only see CEOs, but there's a greater role for CFOs, either front stage or backstage. That's from Mike, I guess.
That's a very good question too. And the skill set of pitching is its own skill set. So I have seen CFOs that are engaging people that can do a good pitch, do the pitch. I have seen CEOs do it with the CFO there, able to come up and answer a detailed question. The CFO definitely needs to be a part in its construction, but who delivers it? That's really just whichever skill set is best able to do it.
Yeah, because as we've seen, sometimes a CEO is not a good delivery person. They should really be in the back and have someone else do it. Same thing with CFOs, especially if they're very number driven. They may not be good speakers. So that's really good. Do you, as investors, do you expect, in addition to the financial projections, for the entrepreneurs, the CFOs, the startup, to have KPIs in place that they say, we base these on certain KPIs? Is that something you usually see or expect?
I probably don't see it as often as I would like, and that doesn't mean that some companies aren't using KPIs, but simply not bringing them forward. But it doesn't matter whether you're a fast growth startup that raises VC capital or you are a mom and pop startup in a local community. You should absolutely know what your KPIs are and measure them and build your plans to perform to them. Now, what degree those need to be shared with investors, I think it's kind of one of those things that you always have up your sleeve, right? If an investor is challenging an assumption that they think you've made, and you can come back with a great response and says, here's how we arrived at that assumption. We researched this, we calculated this, the math and equaled that. And the investor goes, wow, yeah, you did it. You understand what
sure.
Exactly.
So Jeff, KPIs, just to let everybody know it, if they don't know, key performance indicators, that's what it means. What is a financial ratio, or what are financial ratios, and is using them necessary, or is it helpful, especially when it comes to trying to fundraise and the financial projections?
Oh yeah, you bet. This is one of the areas of discovery I like. It's a light bulb moment for a lot of folks. For those who don't already know, a financial ratio is about the simplest kind of math any adult can do. Okay, and simple is why I gravitated to business math and not biochemistry and quantum computing. Okay, a financial ratio is taking two numbers, often right off of a common financial statement or from your customer data, and dividing one by the other. That's it. But what that does is it correlates them. How does a change in one relate to the other and impact the answer? Mm-hmm. Now, some ratio answers are better when they're smaller. Some are better when they're bigger. Usually the learning in financial ratios is understanding what a given ratio means, right? What it's telling you. But the math itself is simple. So here's the key. Here's how you use financial ratios. The tip of the iceberg is this. You measure a ratio, and then you measure what it was before in your own company. How did it change? If it got better, keep doing that. And if it got worse, that's an early warning sign. That's what they are, is they function as early warning signs to tell you where to focus on fixing something. Okay, but like I said, that's the tip of the iceberg. The real power in ratios is taking your ratio or your ratio trend and comparing that to your industry of peer competitors or to comparable industries that behave the same way. That's the real power, because it's being more efficient than your competitors or offering a better value to your customers. That's how you win.
So I know you can talk about this for hours. So just to clarify, that better or worse doesn't mean higher. Better doesn't mean higher. Sometimes better could mean a lower ratio.
That's right.
And worse could be a higher ratio. So it depends what you're looking for, just to make sure everybody understands. And there are a lot of tools out there, as you and I know, a lot of online platforms that gives you access to data to compare your industry. I think Profit Sense is one of them, I think, right? There's a plenty of others.
That is one. BizMiner is another good one that I use a lot.
Yeah, so there's a lot of tools out there that really help with that. I'll take on Paul Stein's question. He says, when it comes to projections in other fields, like where hurricanes or pandemics might go, we see triangles, not lines. Why can't potential income ranges be given conservative to amazing?
I can't claim that disaster planning has been something I've done a lot of, but here's what my intuition tells me. I agree with you. Why can't they? It's probably just somebody won't sit down and do the rigorous math.
Well, there you go. You got your answer, Paul. I think I really want to tell the audience about what you do. You have this cohort program that you put together, and tell us about it a little bit, because I think it's very beneficial to anyone who really wants to learn finance for their business, regardless of what stage they are in.
Yeah, this was really just kind of a side project that popped up some years ago when I was in a community where I was working with the local college executive and the chamber executive and the SBDC representative, and everybody agreed the community did not have a good entrepreneur onboarding program to offer. And certainly there's many out there, but most of the programs that you find offered tend to be those very basic mechanical things like, should I be an LLC or an S Corp? And, how do I find an accountant? And, you're given a really, really basic template for a financial projection that isn't very effective. And there just really wasn't something good off the shelf. So I decided to create it. And I spent a couple of years creating and testing a 12 meeting and 8 lab program, out of the back of which you come with a complete comprehensive 5-year strategic plan that is financially informed. And there's a tool that I created around that called Sybil. Right now it's in a spreadsheet format. One day I'd like to turn it into a web-based format, but us finance guys, we love our spreadsheets. It asks and makes you answer questions that most other projection tools never even ponder, so that you can really nail it, so that you can really get it down to the, to the dollar. So that's what it is. I've taken cohorts around the country through this. I call them boards. We make sure that there's up to 12 non-competing participants on a board. We work through this material, and that board tends to hang together as each other's virtual board for years into the future, because of the relationships they've built in the process.
They truly end up becoming a board. So can you tell the audience where to go and get some information on that?
Yeah, I'm pretty old school. Just reach out to me by email or phone. If that's not something that's already been provided through this format, I'm sure we can stick it in a chat box or something.
Sure. Anyone who wants to know information about the program, please email me at pvinfo@pismoventures.com, and I will email the information to Jeff directly. Thanks, Jeff. It really sounds very interesting and very beneficial. I know it is most of the time it is a weak part of any startup is really that financial piece.
Mhm.
So some of the other things I hear is I'm confident in my ability to adapt to whatever happens in place of detailed planning. Why isn't that good enough?
Well, okay. It is if investing your savings every week in lottery tickets is also good enough for your retirement plan. Now, look, there's nothing wrong with uncommon levels of self-confidence. I would say it's a rather required trait in all of us who have been entrepreneurs. But there's a difference between confidence that comes from experience and the arrogance that lacks experience, right? So that scrappy ability to pivot and adapt the right way in the moment, none of us is born with that. None of us, okay? It's developed from being able to admit early on what we don't know and study and practice and measure and repeat until certain patterns in decision making become intuitive. So if you've started a few times already and you've exited once or twice for a good ROI, then you might be able to fast forward and skip some steps if you're really just doing another rep in an industry you've been in before. But if you're a first-time founder, or you've only assisted other founders without a great deal of your own money at risk, or if you've been a founder before but you're in a new industry, you're starting something in an industry you haven't been in before, then you really haven't been through your paces yet. And if you get too far out over your skis, you'll still learn, but it tends to be negative reinforcement style of learning for you and the others depending on you.
Yeah. Great advice. What skills also do you think someone should look for when they're filling the role of a CFO? Of course, when you're a startup, that role mostly is outsourced.
Mm-hmm. Yeah, and it will be for quite a while until the enterprise is growing up, and that's fine. It's where we started. First, when you're looking for that CFO skill, understand the difference between accounting and finance. Okay, you're not looking for an accountant that's trying to wear the CFO title. All right, it's not interchangeable. Now, a good finance professional is going to have balanced abilities both in the analytical left brain stuff and the creative right brain stuff, okay? Someone in finance isn't going to be too rigid and inflexible and stuck to the process, and this is how we have to do it, all right? That's what you'll find sometimes more on the accounting side of things. Now, I think of a good finance professional as a dragon, is not afraid of a dragon. They'll hunt them. The dragon is risk, and they're intent on destroying that dragon. Okay, so they want to remove and minimize all threats to success, and do it with objective planning rather than just using blind faith.
That's what you described is not really easy to find, having that balance. So yeah, I don't know where you could find somebody like that. Well, they have to be mostly entrepreneur type CFOs versus traditional big company type CFOs.
It occurs to me it's no more difficult than finding the right CEO. That's hard. Or finding the right CSO. That's hard. I mean, the talent, it's really funny in this post-COVID environment with lots of unemployment. I just saw a survey that 50% of companies still can't find the talent they need. So talent is always in short supply. You've just got to interview as many people as you can.
Yeah, that's very true. Talking a little bit about the climate. So a question about the current climate. What does today's investment landscape look like from an investor standpoint and maybe from an entrepreneur standpoint?
So I think that we are in a condition none of us expected, because I was right there in the middle of the conversation in March when everybody said, oh man, valuations have really been overblown for the last several years, and this is going to be the reset button. Valuations are finally going to come down. Well, the data now is revealing that has not been the case. Valuations have stayed high, and what else has very weirdly stayed very high. Well, the stock market. We haven't very weirdly. Yeah, everybody be careful with that one. So much liquidity has been, excess liquidity has been injected into the marketplace that there is a ton of dry powder, and there are people who weren't even investors before that are trying to invest money. So that creates competition for deals, which drives values up. It's not going to stay this way because the government can't afford to just keep creating phantom money. There's people who believe they can forever, but I'm not one of those. I'm a guy who does the math. So, at some point the spigot's going to get closed, and then things are going to begin to reset. So my advice to investors right now is don't relax your standards. If anything, improve them. Look for only the best deals, invest only in the best deals. There's a lot of risk ahead still in the marketplace.
A lot of risk ahead. I agree with you. No one should relax, what they're looking for, because, you have to invest always in the best deals possible because the risk is really high.
And if you want to be one of those companies that passes the muster, is one of the good ones to invest in, you got to do this homework. I'm telling you, you got to bring an ironclad financial plan to the table. If you're just coming with the typical hockey stick projections and hardly any, when you get asked the question, how did you come up with this? Oh, well, it seems to be what other companies have done before. Yeah, you're probably not going to get the investment.
Yeah. Okay. So to piggyback on that with a question is, a lot of time when we're looking at presentations, I think most entrepreneurs just splash the financial projection on the screen for about a second or so, and then they say, "Oh, if you have any questions, we can talk afterwards." What are your thoughts around that?
Well, I'm gonna give them at least a little bit of a pass. We make it pretty tough. I mean, the nature of the environment in pitching is, you get 10 minutes or 12 minutes. You have so much that you're trying to cram in, and then you have this really limited question and answer period. It's okay to summarize when you're in the beginning part of the screening process. Really, it's incumbent upon us as investors to operate very good due diligence meetings when we're deeper in to evaluating the company, doing our own homework, sitting down with the company, comparing our findings with, their claims, trying to marry that up and reconcile those things and ultimately decide if it's the right investment for us.
Yep, that's true. Let me see. I didn't see if I have any questions. So I don't have any questions from the audience. Maybe last question for you. Should someone be married to their financial model?
You should be married to your financial model in the way that the person that you're married to, you should know them inside and out. Okay, you should know everything you can possibly know about them. Now, do people change? Yes. And do financial models change too? Yes. And if you know somebody or you know your model very well, change is okay, right? You can accommodate it.
So talking a little bit about all this and the business plan competition or any potential pitch competition that is in place, and there's always a lot of them, but of course Bismos is better. So tell us, what do you think someone should be looking to do when they are actually presenting their business plan, not only from a financial standpoint, but in general? What should they really be doing in order to attract the investors in the room?
There is still something to be said for first impressions. And it's going to be in the first probably 30 seconds to a couple of minutes for most people. The first thing you've really got to get across is that what you're offering is so distinct from the next nearest competitor that you can carve out a market share for yourself. If you can convince us of that and then show us the math of what that's worth and that it's profitable, you stand a pretty good chance.
That's really good. All right. Let's see. There is a question from Dwayne. I'm sorry. Any suggestions from someone considering striking out in consulting?
Well, certainly being a subject matter expert is got to be required, and I'm going to presume that you probably know more things about IT than I've ever even dreamed of. So that's great. Just like every entrepreneur, you're a COO. Now, the real question becomes: have you defined who your target market is? Ideally, a group of customers that are not being well served that you have access to. Have you determined what they're willing to pay to get better consulting? And can you build a business model around that that's profitable? If you can do that work and show that business model is going to work for you, do it. Go for it.
All right, Jeff, thank you. I'm going to do a little bit of closing, but I'm going to come back to you and ask you for a recommendation, one advice that you think entrepreneurs should take away from today's discussion. So I'll be right back. I'm just going to do some closing, and I'll be right back. So everyone, thank you for being here today. I just want to thank you for being a good listener and coming back every Monday at 11. Again, if you have not subscribed to our YouTube channel, please do so you can stay up to date. Also, this specific recording will be available tomorrow morning for you to review or maybe share or pass along to others. Also, follow us on social media, LinkedIn, Twitter, Instagram. They're all available. If you did not hear about the business plan competition that Pismo Ventures is putting together, the applications are open now. You can always go to pismoventures.com and click on the link. I also put a link in the chat for you to be able to see more information. Jeff is one of the judges. We have more than 120 notable, very experienced judges that are on board. So the feedback that you will get from the competition by itself should be of great value. We have also 22 webinars, and Jeff will be holding one of the webinars specifically on finance. So when you register, you get access to all the webinars, and you get access to all the live judging, so you could see or hear all the input that everyone will have. Next week, we have Quan Nguyen. Quan is also a judge on the competition, and he's also a TCA member. And also he runs an IP law firm as well. After that, we have Mark Skiest, who is a transactional attorney here in Orange County. And the week after that is Jay Cormier and Thomas Lee, Dr. Thomas Lee. They're both on the life science panel for the competition, and also for Tecos Angels Orange County. So you're going to get a lot of information when it comes to life science. So come back in the next 3 weeks. We have more coming after that. If you have any questions about the competition, don't hesitate to email me or ask. Jeff, tell us, what is it? What's that one advice?
That's a tough one, JJ. How about this? More objectivity, less subjectivity.
That's I couldn't ask for less from a numbers guy, so there you go. That's perfect. We had a couple of notes here. Some people saying, what a great idea, significantly better than others. So talking about, well done, Jeff. How do we persuade investors to invest? How about that? Last one from Lil. How do you persuade investors to invest?
Well, if you're a startup raising capital, boy, that's always your biggest question, right? And we've kind of covered that. You want to show a plan that you have beat up so badly that the investors can't beat it up anymore. And when they can't beat it up, that usually instills their confidence to invest.
There you go. And like you said, carve out that piece that you think you could do better than others. Well, Jeff, thank you again. You've been awesome, and I look forward to seeing you in the competition and shortly in other TCA type activities as well. Thank you very much. Have a great day.
You too. We'll see you all there. Thank you.
See you. Bye-bye.